we are entering into the next topic, and that is the service which we have already started learning about, insurance. And we have learned insurance is a contract whereby one party agrees to make good the loss happening to another party. So here we are going to see the classification of insurance and some of the types. So we are entering into the next topic, that is types of insurance. Types of insurance. Now, types of insurance. Insurance, it's an agreement whereby one party agrees to make good the loss happening to a subject matter for an amount received from the person who is insuring it. And there is subject matter. On the basis of subject matter, insurance can be classified broadly into two, that is life insurance and general insurance. Life insurance and general insurance. There very clearly it is saying that life insurance is the insurance where the subject matter which is covered or which is being protected under the contract is life, and all the other things except life will come under the classification of general insurance. Now we are going to see what is life insurance. What is life insurance? Life insurance is nothing. It is an insurance which is provided for protecting the risk or protecting the loss happening or uncertainty happening to life. It provides protection against the uncertainty of life. If anything happens to life, death or accident or any trouble happening to life, it will be covered under this insurance. So it is providing a protection against the uncertainty of life, and the person who is being protected or whose life is being protected, that person is termed as assured. Insured itself, but we use a terminology called assured. The person whose life is protected, or the person who is taking insurance policy to protect his life, that person is called as assured. And it is a contract. It's a contract whereby insurance company undertakes to insure a person in exchange for a premium. We have seen what is premium. Premium is an amount, it's a lump sum amount paid to the insurance company. In return for that, they are agreeing to make good the loss happening to subject matter. Here also, insurance company is saying that we will help you to overcome the loss, overcome the problem happening to your life, and that is the agreement. That is in return for a premium, and this premium can be paid in lump sum or periodically. It is paid in a single stretch, a big amount, or it can be paid periodically, monthly or quarterly or half yearly, whatever be. So for that premium received, insurance company is saying that we will protect something happening to your life. It can be death, it can be accident, it can be illness, anything happening to life, and it provides a security to the assured and his dependents. One of the feature or particular feature is that it's providing a kind of security when something is happening to you. Your dependent, your wife, children, or your relatives, whomever be, your father, mother, whomever be, they are getting a sense of security. They are getting a sense of security. But you have to keep in mind, in life insurance policy, rest of all the principles will be applied. There is insurable interest, there is utmost good faith, there is subrogation, there is mitigation, everything is there, but one principle cannot be applied in life insurance, and that is the principle of indemnity, because a human life cannot be valued in an amount of money, or it cannot be compensated by paying an amount of money. It cannot be compensated. So It is providing a security means it is helping to adjust with the situation, not as it was, the person was there. It will not happen like that. So, indemnity principle is not applied, is not applicable in life insurance, but still it provides a kind of security for the dependents. For time being, they will be able to adjust with the amount they are giving, the insurance company is giving on a death or an accident, whatever be. And one more thing you have to keep in mind, insurance company is not just meant for protection alone, it is also meant for providing or encouraging savings also, because that they are paying this premium every month. Every month they are paying the premium. So, for that it encourages the saving habit. Every month they have to pay the premium, every month or quarterly or half yearly. It encourages premium. So, the savings can be invested into life insurance. So, in that way, life insurance is encouraging saving also. So, basically speaking, life insurance is all about insurance company agreeing to protect the risk or problem happening to life of a person for an amount received from that person as a premium. So, here the subject matter is life, and that is why we are calling it as life insurance policy. Now, there are different types. For catering to different types of people, there are different types of life insurance policy. We are just listing some of the type of insurance policy. One is whole life policy. Whole life policy. And in whole life policy, as the name says, the insurance will have to pay the premium for a fixed period, maybe 20 or 30 years, according to the variations made by the insurance company. They will have to pay for a longer period, a fixed period. And in whole life policy, it is called whole life policy because it will not be paid, the amount will not be paid to the assured. The amount will be paid only to the dependents on the death of person who has taken the policy. And it is payable, what to say, policy will be continuing till the death of person. Only on death of person this amount will be paid to the dependents or legal heirs. That is why it is called whole life policy. Whole life policy. The only beneficiaries will receive it. All the legal heirs will receive it. So, that is why it is called as whole life policy. That is one of the type of life insurance policy. Now, there is another type of policy which is called as endowment policy. Endowment policy. Now, there is a slight difference between whole life policy and endowment policy. Endowment policy is a policy whereby, what to say, the insurance company agrees to make a payment either on the death of insured or assured, or when he attains a particular age, whichever is earlier. So, either it will be paid at the death or he attains a particular age, whichever happens earlier. Say 60 is the age fixed by insurance company. So, before 60, if death of the assured is happening, the beneficiaries will receive the amount. Otherwise, if the assured is still alive after 60 years of age, assured will receive the amount, a lump sum amount is received. So, what to say? This is what is called as endowment life assurance, either on death or on attainment of a particular age, whichever happens earlier. So, the difference is that it is not needed that death of assured must happen, but in first case only after death of assured they will receive the amount. Third one is joint life policy. Joint life policy. Joint life policy is taken by, as name says, joint, there must be more than one person. It is taken by more than one person, either wife and husband or partners. And this type of policy, you have to pay the premium, and it will be payable on death of any one of the person to the survivor or survivors. So, what to say? Amount you have to pay, you will receive the payment, not you will receive the payment. Any of the surviving one will receive the payment. Any of the surviving one will receive the payment. So, that is what is called as joint life policy. More than one person takes a policy together, and it is payable on happening of death of any one of person to the survivors. Anyone, if that person dies, the survivor will get the amount. So, that is what is called joint life policy, more than one person taking the insurance policy. Sorry. Okay. Coming on to annuity policy. Annuity policy, what to say? Nowadays, we are hearing much about pension schemes and all, which is put forward by insurance company. In a way, it is the annuity policy. That means assured has to pay the money, or what to say, the policy money is being paid to the assured. He will have to pay the installments for a fixed number of period, and on the attainment of a particular age, that amount is paid in installments to the assured. It can be half yearly, it can be monthly, it can be quarterly, whatever be. So, in installments it will be paid back. Assured sum will be paid back to the assured. So, this is a method, or this is a policy whereby assured is given the amount back in installments. It has been opted by person who want to have a regular income after a particular age, maybe after retirement and all. If a person wants a fixed income, then they can opt for this annuity policy. They will have to pay the premium till a particular time period, and after attaining a particular age, the assured sum will be paid in installments to the assured. That is what is called annuity policy. And the last one is children's endowment policy. Children's endowment policy. The name itself says it's a kind of insurance policy which helps the insured or assured to meet the requirements of study or marriage or such kind of things, meet the expenses of education and marriage of children when he or she attains a particular age. And it is what to say, the premium is being paid, premium is paid by person who is entering into contract. For example, a father or mother is paying the premium, and this assured amount comes back to the assured for meeting the expenses of education or marriage of their children at a particular age. And if what to say, before attaining what to say, maturity of the policy, no premium is to be paid. So, with that premium, whatever is being paid, it will be paid back. So, this is basically for children, for meeting the requirements of children, either education or marriage. So, that kind of policy is known as children's endowment policy, where father or mother or any relative is taking a policy, is paying a particular amount of premium for a particular number of years, and when the child is attaining a particular age, it is being paid back to meet the expenses of that child's education or marriage or whatever be. So, that is called children's endowment policy. So, these are the types of life insurance policy, and we have seen what is life insurance policy.